Hello, welcome to today's webinar, How to Export from the US to the EU. Thank you for joining us. My name is Dave Noah, and I am founder and president of Shipping Solutions. Since 1995, our export documentation and compliance software has helped thousands of successful exporters more efficiently generate accurate export documents and stay compliant with import-export regulations. To help educate our customers and the wider international trade community, we regularly host free webinars like this one on the various aspects of international trade. Today, we are very lucky to have Alessio Lencioni as our speaker. Alessio is the head of product and strategy at VAT IT Stream, where he leads the design and delivery of cross-border trade solutions for U.S. businesses expanding into global markets. His work bridges the gap between strategy and execution, helping companies of all sizes navigate the complexities of logistics, duties, VAT, and the international compliance. With a focus on practical outcomes and scalable systems, Alessio brings expertise in turning global trade challenges into growth opportunities. So, let's get started, Alessio. Please share your slides and begin your presentation.
David, thank you very much for the introduction, and it is a pleasure to meet all of you today. As David mentioned, my name is Alessio Lencioni, and I am from VAT IT Stream. And over the next hour or so, I'm going to tackle a couple of the topics that are front of mind for many US businesses, and that is specifically with respect to exporting into Europe. For a lot of companies that I meet, shipping within the US is second nature. Shipping to Canada feels manageable, and Mexico, in many instances, with the right partner, is workable. But Europe, in many instances, is something that many businesses feel is rather complicated. And the reason being is that there are language barriers, there are different countries that fall within a greater union of customs clearance, and there are layers of customs rules. And a large point that to many US businesses, because it is a foreign system, there is the overarching aspect of VAT, or value added tax. That is an extra complexity that a number of people and businesses do not feel comfortable tackling. So it's a system that doesn't necessarily exist in the States, but it completely dictates how business is done across the Atlantic in Europe. From what I hear from most US businesses and exporters that I work with is that we would love to sell into Europe, but the compliance side is what ultimately scares us. Maybe it's the horror stories, that shipments getting stuck in customs for weeks, or the unexpected tax bills that come with that. But products shouldn't have to be uncompetitive with hidden costs in a market like that. So my aim today is to try keep things simple. I want to break down what those roadblocks are. I also want to speak about what those roadblocks are candidly. I don't necessarily want to shield away what some of those complexities are, but I ultimately want to show yourselves that are attending today, and as well as other US businesses that typically run into trouble, that there are real world examples that can be used as examples that can show that hurdles can be overcome, that we can outline practical and step-by-step approaches that we can ultimately apply to a number of businesses in multiple fields and multiple industries that ultimately are interested in going into the European market. So if we just look at the two primary aspects that we want to focus on today, the first one is looking at the challenges that US businesses face when moving into Europe. So this, in many ways, is the current state, for lack of a better term. And the second aspect that we'll look at, and it will also involve a real-life scenario, is looking at the future-proof solutions that encompass all-inclusive distribution into Europe. And I know that sounds like a mouthful, but we will break that down slowly but surely. So when we look at the challenges when exporting to Europe, a large part of it primarily is focused around customs checks and paperwork. The EU is meticulous with documentation. Every shipment needs to be properly prepared with commercial invoices, packing lists, and accurate commodities. It's a standard that many of us will know with exports globally. However, it's not sufficient to just throw HS codes on there. You need precision. The catch is that the US style of paperwork is to a certain degree different with the European standards for clearance. Something that looks fine here may be considered incomplete by EU standards. And when that happens, customs don't simply shrug it off and let it through. They stop the shipment, there are inspections, there could be delays, and there could also be the requirement of a return shipment. Now, small errors like this, such as missing importer codes or misclassified commodity codes, is something that can trigger those inspections. And in summary, if we really have to focus this down onto 3 primary points, we can look at it as increased document requirements, stringent entry requirements, and the increased possibility of customs delays. Now, if we have to break those down in terms of the 3 primary points, increased documentation requirements. So every shipment needs that detail on the commercial invoices and the packing list and that supporting documentation. But that can also go as far as the specifics with regards to the HS code. Now, the HS code utilized in Europe is slightly different to that used, which is more commonly referred to as the HTS code for imports into the US. The US has 2 additional numbers as opposed to Europe, and certain classifications for the last 4 digits or 6 digits, depending if you're in the US, can be ultimately slightly different. The first 6 digits for classification do stay consistent, but there does need to be that added level of scrutiny and assurance paid to those HS code classifications that there's no room for inspecting customs authorities to potentially draw down on the fact of misdeclaration of goods. And that kind of leads into the stringent entry requirements. So customs authorities, I think, given the current global sphere of trade at the moment, are more vigilant than ever. I think they realize that a number of businesses have shied away of trying to import to the US because of tariff increases. So they're looking at Europe as a second best option in many instances outside of the European market, outside of the US market as their primary import. And unfortunately, US exporters fall within that same categorization and larger net of stringent entry requirements. So we're seeing it more than ever that shipments are being scrutinized with a fine-tooth comb. Now, when we speak about increased possibility of customs delays, the more checks and the stricter rules can ultimately result in delays. Now, any of us on this podcast today or on this webinar today know that the requirements when it comes to customs delays in the world of shipping are it's part of the fabric of international shipping. However, what we always try to do is we want to mitigate that as much as possible, and ensuring that all that detail is there, and it leads back to the previous 2 points, are fundamental to exactly that. Now, the second point that we have to look at in terms of challenges are the ever-present tariffs and VAT component. Now, VAT, as previously mentioned, is where things do get particularly tricky for US companies. Think about this in this particular way. So every shipment that you send into Europe will have import VAT applied at the border. That VAT, however, is recoverable if registered correctly in the EU or in the particular country where that customs entry is actually taking place. But if you haven't got your setup correct within that place of entry, then it becomes a sunken cost. It's a cost that ultimately cannot be recovered theoretically in an easy manner. And ultimately, that eats directly into your margin and does inhibit cash flow. Now, there is also the potential issue of double taxation. If you don't set things up properly, you can end up paying VAT twice. Once at import and once again when you're invoicing out that client, because wherever that sale is taking place, there will be the requirement to ultimately charge sales VAT. I've seen businesses lose large sums of money doing this without the correct setup in place. And it's something that does need to be avoided and is very easily avoidable with the correct setups in place. Then, thirdly, there's the question of the importer of record. Who is legally responsible for those goods when they cross into Europe? and who is actually going to take accountability for the clearance event of those goods. Now, there's a number of ways, again, that this can be structured, but in many instances, and we're seeing this trend quite largely occurring, specifically in the B2B space, where European customers are not willing to act as the import of record. So how do we ultimately get around those challenges? And how do we ensure that we don't trip ourselves up in making the wrong decision or a knee-jerk decision in order to try to remedy that? So just to delve a little bit deeper into it. So the possible import of record requirement. This is one of the trickiest aspects in determining who needs to be the importer of record. If you as the seller don't take on this role, your customer is going to be expected to fulfill this role in a more organic manner, which requires them to be liable for any customs clearance effects or any additional cost from a clearance event that takes place. Alternatively, you might have to employ the likes of a import of record service. That is largely very expensive because it is most likely linked to the cost of the actual goods and is not a competitive or scalable scenario for many businesses to really do this on an ongoing manner going forward. So this is something that needs to be set up correctly and doesn't need to necessarily be done with the likes of an import of record service or with the likes of your client having to be in the import of record. And that's something we'll touch on a little bit later. Import VAT loss and complexity. Import VAT isn't just another tax. It's ultimately a cash flow issue. If you're not registered correctly, you can't reclaim that VAT. If you're shipping goods in if we get a little bit technical here, in a DDP fashion, and your client is acting as the importer of record, then again, that import VAT cannot be reclaimed, even though you are fitting the bill for it, because your client is acting as the importer of record. The same issue goes into effect with an importer of record service. Because they are acting as the importer of record, it makes you, as the seller who's paying for said VAT, very difficult for you to actually reclaim it. So that process for reclaiming VAT can be complex if not set up correctly, and does vary by country. And it does require to a large degree, a solid and robust record keeping and filing solution in order to gain the primary benefit of that. And again, just to touch on it again, the double VAT charge is always a risk that is run. So in many ways, and excuse the pun, it can be considered double whammy, where you are paying import VAT and you're being forced to charge sales VAT. Therefore, you are theoretically paying it twice without the ability to ultimately recover it. The third point that we ultimately look at, and this is more extensively linked to the logistics aspect of what we're speaking about today. And the world of compliance and logistics is ultimately always going to be linked when we speak about complex customs entry procedures. And this is where a lot of businesses act in a knee-jerk fashion. They assume the only way to solve the problem is to set up a company in the EU. So we've seen a number of businesses go and buy shelf companies in the Netherlands or in France or in Germany, and ultimately, they go through the cost and hassle of incorporating a business, hiring accountants, getting a virtual office, registering for corporate tax, only to later realize that it wasn't actually necessary in the first place. And then there's the question of returns. If you're selling into Europe, at some point, you will have goods that are coming back, whether it's for repairs, replacements, or customer returns. This requires a clear process. Those returns can trigger additional customs duties, as well as potentially additional levy tariffs when coming back to the US. So this can create a logistical mess if it's not dealt with correctly. But again, not to be a fearmonger, and just to lay everyone's concerns to bed, what we will focus on the second portion now is how do we actually overcome all these challenges and hurdles that we've spoken about. So just to summarize, mistakenly setting up an EU business. So although many companies look at this as an attempt to solve the all-inclusive logistics solution into Europe, where all duties and taxes are included, and go as far as setting up that legal entity, it's costly, time-consuming, and a process that brings on additional obligations. So think of local tax filings, audits, and ongoing administrative work. It's unnecessary and creates more problems than it actually solves. The second aspect of it is the unrecoverable taxation costs. If you're not reclaiming your import VAT and you are paying unnecessary taxes to the wrong structure, you're simply losing money, and you're going to ultimately run an uncompetitive global distribution strategy into Europe. It's a competitive market with very competitive local businesses. So in order to really maintain that level of competitiveness in said market, we need to ensure that all of these aspects are set up correctly for you to maintain foothold in said market. The third aspect of it is something called permanent establishment risk. Now, this is something we haven't necessarily spoken about previously, but it's something that needs to be well considered. So when operating in the EU, if you do not have the correct structures in place, it can inadvertently create a permanent establishment risk. So what I mean by that is that if you've gone and set up a business such as a shell company of sorts in the Netherlands or in Germany, but you're now storing goods in a warehouse, you might think you're compliant, but you are still not fully compliant because there's a requirement now for you to register for VAT in that said country. So it's an additional obligation that you now have to go and do over and above that your local registration or company registration is insufficient to actually resolve. So this is a risk that we see many businesses overlook until they receive a letter from the respective tax authorities explaining their liability to them and ultimately what the associated costs of that liability are. Then the last aspect of it is the complex returns facilitation process. Returns in themselves can be considered a maze. Goods coming back from the EU can trigger additional customs procedures, duties, and VAT complications if there isn't that robust system in place. However, this is a solution that, together with shipping solutions and global gateways, we've been able to design a very streamlined process to ensure that logistical and financial potential nightmare doesn't occur, and to ensure that we get all those reciprocal tariffs, if they are applicable, excluded, as well as any exemption codes applied. Now, something that I ultimately find quite useful to try and wrap one's head around something that is quite abstract that we've spoken about now is to look at a real world scenario. And what we're looking at here is a company that we've actually done quite a lot of work for. It's a company we've had a long-standing relationship with. We've changed their name, obviously, just for confidentiality purposes. But this business was in a world of indecisiveness in terms of how they were actually meant to go about solving their solution. And this company here, by the terms of ABC Limited, is a US manufacturer of industrial components. They sell industrial components to a plethora of businesses all around the world. But they had seen incredible success domestically in the States and had also done exceedingly well in Canada. So Europe had always been on their radar because there was quite a large customer base there, but they specifically stayed away from it purely because of the administrative red tape that was associated with going there. However, there came a turning point, and it was something that happened quite organically when they landed quite a large contract with a German client. And it wasn't something that they could simply pass up. At first, as mentioned previously, they considered setting up an entity in Germany. However, the costs and the complexities, the language barriers and the likes of was something that was largely overwhelming. And instead, this is kind of where we interceded, and we were able to put them on the right compliance structure and path right from the onset. And if we look at the key aspects that we were ultimately able to get them set up with, and I know some of these terms might seem quite abstract, but we got them set up with an EU, so European Union Importers Code, something that's more commonly referred to as a EORI number. Then we also got them a fiscal representative setup. Now, we'll touch a little bit more on what a fiscal representative is, but this is a key aspect that allows you now to also register for VAT. And something that we ultimately did with them here is that Germany does not allow for foreign businesses to get an importer's code if they do not have a physical presence in said country. Now, what we mean by physical presence is that will actually require you to have not necessarily a wet lease, but a physical lease on a building with employees. So you can't necessarily even make use of a shelf company to get that importer's code. So it would require you to actually set up a subsidiary of your business in Germany, which you can imagine the costs associated with that. So in this instance, we opted to actually set them up with a VAT registration and an importer's code registration in the Netherlands, purely because it's geographically right next door to Germany, but also allowed them a procedure and a system for future expansion into Europe. The Netherlands is perfectly located in terms of both maritime, so for ocean freight as well as for air freight, and as well as intra-European road logistics. So they've got a very well-connected road network as well as rail network across the whole of the European Union. And once those goods are in the European Union, they are within free circulation. The fourth point is a VAT deferment for easy cash flow. And this is an optional structure and something I'll touch on a little bit later. And it's something that is, in metaphorical terms, the cherry on top of the solution that we'll speak about today. And the fifth point, just to touch on, and it's arguably something that really brings it all together, is the quarterly VAT returns. So that's actually the summation and compilation of all the import and customs clearance documentation, all the sales invoices and import commercial invoices that we use that are all bundled together in a correct format and reporting standard that are then submitted to the respective tax office. And in this instance being the Dutch tax office. So if we look at it in this practical scenario here, we were able to get them set up so we were able to get ABC USA set up in the Netherlands with their own Dutch importers code registration, as well as their own Dutch VAT registration. They ship their goods from the US to a Dutch hub. This is something that we've already got set up and negotiated with trusted partners. So it's not a requirement for you to now go source a foreign hub. And what we mean by hub, it's basically goods that get flown in, they get customs cleared, and they move directly out of this warehouse. So there's no storage charges that are incurred or anything like that. Once that customs process has undergone, has been facilitated by pre-approved processes. So basically, before those goods even leave the US, a customs pre-approval is already submitted to the Dutch tax authority to ensure goods flow seamlessly through that customs clearance process. The goods then move in an intra-European transfer through to Germany. So, as mentioned previously, because those goods have undergone customs clearance in the Netherlands, there's no further customs clearance that's required when moving those goods from the Netherlands to Germany. So, it's, for all extents, a domestic movement of goods. The German customer, in this instance here, would receive their goods, no paperwork, no unexpected bills. The goods would literally move as easily as if you were sending something from Texas to California. Now, I know this ultimately for them used to feel rather impossible. It's become something that's quite routine now for them within their business. And we've been able to expand this to a number of other European countries too. So it's been quite interesting and for me quite satisfying to see how Europe has actually become a core part of their business model and quite literally a third arm of their revenue. So I think if we kind of speak about the solution in summation, and I want to kind of go through this in a step-by-step process with you. Registering for an EU importers code. So think of the EORI, and I'll use the technical term here, so the EORI, as your business's passport for moving goods into the EU. Without it, your shipments won't get past the starting line. So you won't even be able to customs clear these goods into the European Union. The registration is very straightforward. However, it is essential to this whole process ultimately being started. The second point is now to speak about fiscal representation. Obviously, I mentioned that we would come back to this, but your fiscal representative, for all extents, is basically your local endorsement, and this is your local guide to ultimately ensuring complete compliance with your importations into Europe. This is someone or an institution that understands the EU's tax landscape and can represent your interests from a taxation perspective in the European Union. They will also handle all VAT filings and ensure compliance. And they will also be able to deal with the tax authorities on your behalf with your permission. And this is, together with global gateways, something and a solution that we are able to offer businesses within the European Union if this is something that they're looking at undergoing. Now, once you've got that fiscal representation, this is what now allows you to register for import VAT, which ensures that you're playing by the EU's taxation rules. It's a key part of what makes this all-inclusive distribution strategy into Europe work without any unnecessary hidden costs down the line. Now, to speak about that VAT deferment facility that we mentioned, this is ultimately a game changer from a cash flow perspective. So instead of having to pay import VAT at the clearance event once those goods are cleared in Europe, this VAT deferment is basically an endorsement that can be submitted to the respective tax authority via a small deposit in relative terms to the import VAT amount that basically allows you to defer, or i.e. not pay any import VAT on the clearance of those goods into the EU if you are able to substantiate at the filing stage, so at the quarterly filing stage, that you did in fact on-sell those goods to another VAT registered company. So for all extents, it basically allows you to remove the requirement of having to pay import VAT, provided you've got all the documentation and the deferment in place upon clearance into the EU, specifically if going in via the Netherlands in this scenario. And the fifth point is ultimately staying compliant while facilitating all your VAT returns on time and every time. So with the correct setup, you can reclaim your import VAT, avoid penalties, and keep those operations running smoothly. So just to surmise, what we've been able to achieve here for ABC Limited is that ABC Limited ships their goods from the US to a hub in the Netherlands. Before the goods even leave the US, import clearance is done so that when those goods arrive in the Netherlands, they move swiftly through the Dutch hub with no border drama or clearance issues. This has also allowed them to mitigate any delays or returns at clearance because of that. ABC acts as the importer of record into the Netherlands using their own EORI and their own VAT registration. Import VAT is paid and they then reclaim it in their next quarterly filing. So there's no long-term cash tie-up from a cash flow perspective. The goods are then transferred once they've passed through the hub through to from the Netherlands to Germany as an intra-European movement or transport of goods, meaning that there's no additional customs clearance that's required. The German customer receives the goods without any customs requirement or paperwork or obligation from a legality standpoint. They are simply the recipient. Now, if we have to speak about why the solution works, and this ultimately goes down to something that I mentioned previously with global gateways, is that global gateways in this scenario allows businesses to create a structured process that allows for the three biggest problems to be solved. Customs is handled upfront, so you don't get any nasty surprises at the border. VAT ultimately becomes recoverable, which means you protect your margins and you maintain a competitive ability within the European market. And most importantly, your customer, your European customer, gets a seamless experience. They're not dealing with customs forms or surprise tax bills. They are simply receiving the goods on time and as promised, as if they were dealing with a local European business, which for many of us US businesses is the perfect situation and scenario to be in, because we get the benefits of being able to do business in Europe as if we were a European business, but without having to actually outlay all the compliance attributes and the assets that would be required to actually set up a European facility. So this makes us more competitive. European buyers are dealing with local suppliers who handle all of this for them. If you can match that experience as a US business, you instantly stand out. I think, David, from my perspective, what I'll just do now is I'll touch on some of the common pitfalls and some of the common questions that come up in the Q&A, just to be conscious of the time that we've got today to try and get through as many of the questions as possible. So 4 of the primary questions that I see come up when I have these conversations is, do I need a local EU company? The simple answer is no, not if you do the setup correctly, as we've kind of walked through today. And what can I ultimately reclaim from a VAT perspective? And the answer is that provided that you've been able to set up your processes correctly, your full VAT from an import perspective, so your full import VAT perspective or exposure is able to be reclaimed. Provided you're registered as described and you are able to submit all those filings on time and in the correct manner, you avoid the double taxation risk as well as any further VAT exposure. Will your customers have to do anything? Absolutely not. They simply receive the goods. There's no customs forms. There's no legal obligation from their standpoint. And most importantly, I think we've seen how things have changed so rapidly within the world of international trade in the last, call it 7-8 months. Is this future-proof? And for me, this is one of my favorite aspects, having been intrinsic to how we've built this out for a number of clients. And that answer is most certainly. We've worked closely with a number of different parties in the European Union, as well as shipping solutions, to create global gateways into something that is designed to cope with any upcoming EU customs changes and in order to keep you compliant. So when we speak about common pitfalls that maybe precede or still might come up, even if you've got something like this already in place, I can quite comfortably say that the most common one is if companies cut corners. I often like to compare that to baking a cake. You can't just skip adding ingredients and hope for the net result to turn out perfect and replicable every single time. So skipping registrations or ignoring VAT submissions always and most certainly leads to delays, fines, or again, double taxation. Another pitfall is assuming that Europe works in the same manner as the US. The systems are fundamentally different. So we just need to be conscious of the fact that we need to play to the rules of the European tax authorities and customs authorities in terms of how we ensure success. So I think, and in terms of one of my closing remarks before we get into the Q&A, is exporting to Europe from the US isn't necessarily straightforward without the correct help, but it is most certainly doable. There are challenges, and yes, the paperwork might seem intimidating at first, but with the right partners and with the right structure in place, it just becomes another part of your business. Europe is too big of a market for companies that have international ambitions to ultimately ignore. And if companies get that right, it opens up new revenue streams that can really help them create a new facet to their business that they didn't necessarily imagine. It's basically like unlocking another US domestic market if they are able to get this right. So thank you very much, everyone, for your time today. And I look forward to answering a few questions from here on out. Thank you.
Great. Thank you very much, Alessio. I do want to mention that we are partnering, Shipping Solutions is partnering with VAT IT Stream with our new service we're calling Global Gateway to help provide this kind of support for your company if you're looking at the EU or other parts of the world to export your goods. And we'll have more information about the Global Gateway solution in some follow-up emails that we send you. We have a registration form on our page with the Global Gateway information. If you'd like to speak with someone about your particular situation, we'd be happy to talk with you and find the best solution for your company. So, but in addition to that, we want to be able to provide support to everybody for exporting to the EU. And so we'll tackle some of these questions. First question is, do you have any suggestions on how to obtain EORI numbers? Is there a government site that I can go and get that information, or is email with a client the best way to do it?
So I think in terms of how that has to be done, you would have to first try understand where is it that you're wanting to send your goods and what does your overall strategy look like. David, as you know, this is something that we can definitely assist with. And I think post this call, we'd be more than happy to speak to the attendee in terms of what their ambitions ultimately look like. But you can only ever have one EORI in Europe. So it's important to ensure that you select the right country where you want that EORI to be set up. Because some EORIs can be used in other European countries, whereas others cannot be. So it's just important that we understand what their ambitions are in terms of which countries they want to go to.
Can we only provide the 6-digit HS code on the commercial invoice?
It's not advisable because it does allow for further. You never want to give a customs agent the opportunity to assume what your commodity is. So we always try to say, let's be as exact as possible and try be as thorough in terms of what the classification of that item is. So it would be best to utilize the full HS code. And again, Louis, that's something that we could also potentially help with. We've got a full team that assists you in trying to summarize what the correct HTS classification is for your items. And ultimately, the decision is always yours in the end. But we work with you to ultimately determine that.
How long does the process that you described in setting up exports to Germany for that customer, how long does that process usually take for a U.S. company?
So it's a relatively quick process. So an EORI takes about 1 working week, so anywhere between 2 to 3 or 4 business days to get set up. And an EORI registration can already be utilized once we've got that application underway and submitted to the tax office and we've received receipt of the application. So theoretically, if I have to summarize everything in totality, anywhere between 3.5 to 4.5 weeks to get that process underway and within process that you can actually start utilizing it.
Why Netherlands? Can it be any other EU company for the first leg of that journey?
So it can be. So there is the capability to do a similar process through France. There is a similar process to potentially do this through countries such as Belgium. But the reason why Netherlands was chosen in this specific scenario is because, firstly, the Netherlands allows you to clear goods indirectly utilizing a foreign EORI registration. But it is not possible in all countries. And I think I should just mention that. A primary reason, for example, Germany does not allow you to do so. Spain, Italy, Portugal don't allow you to do so. Another reason in this specific instance is because of the logistics capabilities of the Netherlands. So this company was sending goods via ocean, via air, and the Netherlands provided a perfect port of entry for this client. So again, there's a number of freighters and international routes that go into the Netherlands, both from an air and an ocean perspective, and it's perfectly situated within Northern and Central Europe to allow for easy distribution to countries further north, countries further south, as well as east and west within the European continent.
How much more complex is this process when you're exporting hazardous goods?
It's not at all. So in terms of product classifications, the complexities would rather come down to the classification of the hazardous goods in their nature, but it is not indirectly, it does not have any direct effect on the compliance aspect of this from a taxation and a clearance perspective. So we've got a number of clients that ship hazardous goods using this solution, and it is very easily adaptable to their supply chain requirements.
How about exports to Poland? Do you have a link where we have more information about the specifics of exporting directly to Poland?
So exporting directly to Poland is something that is not entirely possible if you are intending to register an EORI and a VAT registration in Poland. The reason being is Poland doesn't allow for a foreign company to register directly there. But if you chose to go via France or via the Netherlands to distribute into Poland, it's most certainly doable, and we would be able to facilitate it in virtually the exact same way in which we looked at with ABC Limited in the real life scenario above. In terms of where can we find more information, Bob, this is something that the team post webinar can work with you directly on and give you as much information as you require.
Do you register the ABC Limited with an EORI number in the Netherlands? Did you register? Yes. Okay. Is there a way to ship free demos or RMA replacement parts, zero cost, to customers without the customer incurring costly customs fees?
Yes, so there are ways around that. It depends on the nature of the shipment, the nature of the commodity being shipped. But we do a lot within the gifting space as well as in the warranty repair and return space. And we've designed really robust solutions to cater for these exact type of scenarios.
Are there circumstances that opening a physical office in the EU makes sense, i.e. service for goods, warehouse for stock, same time zone for customer service?
I guess there always are. I think when businesses get to a specific scale and a specific size, you would expect them to have that local presence. I think where it becomes specifically a specific requirement is when you actually require boots on the ground. So when you need people within the European Union or within a specific country within the EU interfacing with clients directly, if you need to employ the likes of someone to go facilitate services for an installation and it's an ongoing business, then most certainly. But I think in many instances, a lot of businesses go about doing it unnecessarily because they believe it's the right thing to do. But it's dependent on a number of circumstances. But there's certainly instances where it is preferential.
As a company doing business all around the world, we do a lot of drop shipments. Can we drop ship a shipment from Japan to a customer in France as an American company as the importer of record?
Certainly. So we could definitely register the Japanese entity in, if I understand correctly, in this instance. Or actually, if you're looking at it from a drop shipment perspective, the American entity can always be the importer of record in that instance, and provided that the customer that is shipping the goods from Japan to the European Union has all the information consigned correctly, the origin of the goods is not a limitation to how this system can be utilized. I hope I made concise sense there.
Yeah, that makes sense. How would you handle the process when there's a U.S. export license in place?
If I understand correctly, and I hope I do in this specific scenario, is if there is a requirement with specific US export controls on a specific item being exported. So, for example, if something has an ECCN that is not straightforward, it's not a particular EAR 99, or there's a dual use aspect to the goods, this process can still be utilized.
Do you help provide the documentation required to if there are any reporting requirements that are included with an export license?
So in terms of that, we would work with the client to understand what those requirements are. And in many instances, David, that's when we come to you and we more often than not lean on your services in terms of those export requirement controls. But we work with the client, and where we can assist from an export compliance perspective, do certainly assist.
There is a new EUDR regulation taking into effect on December 30th of this year. How do you see this affecting next year's exporting and importing into the EU?
I think it's something that we would have already seen coming into effect. So I think EUDR is also very specific to certain commodities, specifically those within respect to paper-related goods and deforestation. So from that perspective, we've seen a couple of businesses out of the UK that are in the gifting space with paper and seasonal cards have this type of requirement, but it can be easily remedied and still works with effect with a foreign EORI application.
Did I remember correctly? Did that get delayed beyond 2025? I thought I saw something that it had been delayed for.
I stand to correction. I haven't seen any extension to that.
Okay.
However, we did quite a bit of R&D on that towards around about April, May of this year, and the solution that we've been able to build out for a lot of our clients has been able to, even if it does come into effect at the end of this year, or whether or not it's been delayed, still works within the bounds of a foreign registration.
When sending a commercial invoice for a product, what are the key elements that should be included, and how should they be presented?
I think an important aspect is always the requirements as to what exactly does the tax office want. And I know that's a very generic answer because they're not very good at giving guidance on exactly what that is. But we worked specifically with the Dutch tax office, the UK tax office, and the French tax office to get direction in terms of what that is that they want. And I can quite comfortably say they don't want to have to look for what the commercial value of the goods are. They don't want to have to try and decipher if you're moving 1,000 items and there's a cost of $1,000 per item. They want to be able to easily understand and see that the itemized value of each item is $1,000, and they want to see that the total number at the bottom is $10 million or $1 million. I don't trust my maths off the back of my hand too much. But that's what they ultimately want to see as a first aspect. They also want to see who is the importer of record. They want to see that there's a VAT number, and they also want to see that there's items specifically pertaining to the goods that are being shipped, and that's easily visible. So going back to one of the questions previously, they want to see that the description of goods is clear and concise, that they're not vague. So if you're shipping a shirt, for example, they want to see that the description of goods is a 100% cotton shirt or men's shirt. They don't just want to see shirt. There needs to be a significant amount of detail. The second aspect that they look at from a commodity perspective is the detailed HS code. So they don't just want to see the first 4 digits or the first 6 digits. There needs to be a degree of detail within that commodity code. And again, that the values and the quantity of each commodity ties up to the value that you're declaring from a commercial sales perspective. So those are the key aspects that you would need to look out for.
And I'm going to ask Kari, put her on the spot, and we do have a blog post that talks about what would typically be included in a commercial invoice. If she could post a link to that in the chat window while we continue to answer questions, as well as a link to a template for a commonly used version of the commercial invoice, if you want to take a look at that as well. Next question. I have a Netherlands VAT ID and a Netherlands EORI, but am still unable to import-export to from the Netherlands. I do not have a fiscal representative. What is the problem?
So in order to get your VAT ID number, you definitely would have required a fiscal representative at some point. The reason that you most likely are not able to utilize the structure that you currently have in place is because you are most likely non-compliant with your current VAT submissions, and therefore you're being blocked to clear goods utilizing your EORI. So, Sabrina, we would be able to work with you to get this matter cleared up. We would have to obviously ensure that all your historical filings have been done correctly in order to then appoint ourselves or another business as the fiscal representative to represent your VAT registration, and then ensuring that we get your current state compliant so you can start utilizing the facility going forward.
When shipping to the EU from the US, should we have the EU HTS code on the commercial invoice? On all our current shipments to various countries, we put the 10-digit US code on the commercial invoice.
So you should be utilizing the country of destinations where the goods are intended to go to's HS code. Now, in many instances, and Shelley, we see this quite frequently. The US HTS code and the EU HTS codes are quite similar, but there are still key differences with respect to the last four digits sub-classifications with regards to those sub-chapters. So you should be utilizing, in this instance, the EU HS codes on your commercial invoice.
Now, keep in mind then, if you're required to file that information through the automated export system, you do need to use the 10-digit US code for that filing. We also have on the Shipping Solutions website in our product classification software an HS mapping tool. So if you know what the 10-digit code is for the United States, it will show you the potential codes for any EU country or other countries around the world. So you could try that out for free by requesting a free trial subscription to that if you're interested in doing that. Is it realistic to pass VAT costs onto our end customer instead of absorbing them ourselves?
Yes, you can. But realistically, it depends on who is acting as the importer of record. So if your client is acting as the importer of record, then it is sufficient for you to pass on the import VAT requirement to them. However, if they are not acting as the importer of record and another party is acting as the importer of record, or you are, then you are obliged to charge sales VAT. So you could bundle the import VAT cost if you don't choose to recover it into the cost of your goods. However, it would most likely make the cost of your goods uncompetitive. So it would just be dependent on how you choose to structure the importer of record aspect of your transaction.
In your example, who is the responsible party to file the ENS/ICS2? Would it be for Netherlands or end destination in Germany or the US shipper?
It would be whoever is acting as the importer of record.
Okay. What key items should be included on a checklist for shipping from the US to Germany to help the department avoid missing anything?
I think it's a very broad checklist, and I think I could probably use another hour to go through all those exact details. But I think a key aspect touches on a few crucial points. Who is intended to be the importer of record? Do you have the correct HS codes for clearance? And do your commercial values on the commodities as well as the values on your commercial invoice align? But I think it's quite an open-ended question.
And don't forget about the U.S. requirements as well.
Correct. From an EEI filing perspective.
Yes. How are you handling the use of the new tariff codes, including the codes beginning with 99? Do we add on top of our original one or replace?
So I think this is more of a question with respect to US imports,
Yeah.
and speaking to the exclusion codes. I think outside of the scope of this webinar today, the exemption codes do not replace the HS code classification for those items. They need to be added to the commercial invoice on clearance to show that these items do have the applicable exemption code to be applied. However, it is also on how the customs official clearing your goods intends to have those codes submitted. But I think having it clearly displayed on the commercial invoice is your first starting point.
Do all EU countries require net weights on export documents? Why is this a strict requirement?
I think this is, again, more specific to the type of goods that you're shipping. I think if it's food-related goods, net weight and gross weight can be slightly different. In terms of clearance events, weight is more commodity specific than it is generally specific. If you're shipping T-shirts or peak caps, weight is not a requirement at all for clearance. But I think it is more a requirement to understand what is the net amount of a certain good being imported into a country. and to ensure that there's not a mis or over declaration or under declaration rather of a specific commodity being imported in respect to the packaging that is being imported.
How do you pay import VAT up front?
So it's usually paid to whoever is facilitating the clearance. So if you're moving something with a freight forwarder, whoever is acting as the broker for customs clearance at the place of destination, where the clearance event is taking place, will handle the payment of VAT over to the customs office. So if you're using FedEx and you're shipping on a DDP term, FedEx will handle the VAT aspect of it. If you are shipping on a DAP term or a DAT term and a broker is being appointed at the place of origin, whoever's acting as the importer of record or the client in that instance would be required to pay VAT over to that broker. So the broker will always handle the VAT facilitation.
As of September 2025, fiscal representation is no longer needed for non-EU businesses. Can you still import into the EU without fiscal representation?
Unfortunately, I think whoever submitted this question might be getting slightly misconstrued with the requirements of what is happening with IOSS. And specifically the requirements of ICS2. Fiscal representation is actually becoming it's becoming a requirement for foreign-based entities going forward. So IOSS did not require, which was basically for de minimis goods that fell within the de minimis category within the EU, no longer need fiscal representation, or never required fiscal representation prior, but they're now required to register for OSS, which requires a VAT number, which that in itself requires fiscal representation for.
Okay. And our last question here, can you handle AOG shipments, which are typically very urgent?
Correct. So for aircraft on ground shipments like this, this process helps things immensely. Because you streamline this entire process, and specifically in the aviation space, which is quite a large sector that we service, the value of goods are so high. So where the value of goods are very high, you don't want to just be writing off that import VAT component because you haven't been able to clear it correctly. So most certainly.
So thank you, Alessio, and thank you everyone who attended. I appreciate your willingness to share your knowledge and experience with us. Someone asked if we had a webinar on Incoterms. If you go to the shippingsolutionssoftware.com website and go up to the menu where it says Learn, we have a link to all the previous webinars that we've recorded, and this one will join that, but we have a couple Incoterms related on there as well. In addition, on this resources slide that you can see, we have links to the resources that we talked about today during the webinar, including the new Global Gateway by Shipping Solutions landing page with more information about that service. So if what Alessio was talking about sounds helpful for your company and you want to have a quick no obligation discussion with someone, you can register for that. And we will reach out to you and learn more about your situation and share some options for you as well. You can follow that URL that's on the slide, which is kind of long, or we do have a QR code on the page too that you can just follow, and that'll take you right to that resources page. Finally, I want to recommend that everyone check out the Shipping Solutions YouTube channel. Which is also listed on this slide. We've published at this point a couple hundred short videos discussing the basics of exporting and importing on our channel, and it's very quickly growing in popularity. So check it out, and if you like what you see, please subscribe to the YouTube channel. So that's it. Thank you again, Alessio, for your excellent presentation, and thank you all for joining us today, and stay well, everyone.